questions about today's interest rate announcement and our monetary policy report. Comme vous le savez, le Conseil de direction a décidé d'augmenter les taux d'intérêt aux réunions de juillet et de septembre, dans le contexte d'une croissance économique plus forte que prévu et d'un marché du travail très robuste. En outre, pendant l'été, on a observé un raffermissement des indicateurs de l'inflation et une résorption rapide de l'écart de production. Comme nous l'avons prévu en juillet, l'économie montre des signes de modération au deuxième semestre de l'année. Néanmoins, nous nous attendons à ce que l'économie continue de croître à un rythme supérieur à son potentiel. Aujourd'hui, nous avons laissé notre taux directeur inchangé à 1%. Nous estimons que ce niveau est approprié à la lumière de notre projection révisée pour l'économie et de l'inflation. En particulier, nous prévoyons que l'inflation atteindra notre cible de 2% au deuxième semestre de 2018. C'est un peu plus tard que nous l'avions anticipé en juillet, en raison surtout du fait que le dollar canadien s'est apprécié en 2017. As you know, Governing Council decided to raise interest rates at each of its July and September meetings in the context of stronger than expected economic growth and a very strong labor market. Furthermore, over the course of the summer, we saw a firming of inflation indicators and a rapidly closing output gap. As we predicted in July, the economy is showing signs of moderating in the second half of the year. Nevertheless, we expect the economy to continue to grow at an above potential pace. Today, we left our policy rate unchanged at 1%. We regard this level as appropriate in light of our updated projection for the economy and inflation. In particular, we expect inflation to reach our 2% target in the second half of 2018. This is a little later than we projected in July, primarily because the Canadian dollar has strengthened in 2017. And before taking your questions, let me just offer a few comments around Governing Council's deliberations. Governing Council agreed that the economy is likely to require less monetary stimulus over time, but we will be cautious in making future adjustments to our policy rate. 4 key issues are adding to uncertainty in the projection. These are the same 4 issues that I highlighted in my recent speech in St. John's, and they played an important role in our deliberations for today's decision. Discussion of these issues features strongly in today's MPR. The first issue on which Governing Council spent considerable time is around inflation itself. In this MPR, we investigated a number of conjectures around the apparent softness of inflation in several advanced economies. I refer you to Box 1 of the MPR. These conjectures include a role for technology, specifically digitalization, which may be putting downward pressure on inflation, a role for imported disinflation from lower-cost countries, or, more generally, a role for the forces of globalization. Now, suffice to say that for the Canadian data, this work has generally confirmed our faith in our model of inflation, in which inflation depends mainly on the degree of excess demand or excess supply in the economy, and this process operates with a lag. In short, we believe that we understand how Canada's inflation rate has been evolving. If we've been surprised in the past, it's been either because of sector-specific shocks or because economic growth was slower than expected and there was more excess capacity than we previously believed. Indeed, the second issue that preoccupied Governing Council was the degree of excess capacity in the economy. The economic growth we experienced in the first half of the year has been sufficient to bring the level of production close to our estimates of capacity. Well, let me reiterate, inflation has always been and remains a question of supply and demand. Therefore, one might expect continued above potential economic growth, which we are forecasting for the next few quarters, to cause inflation to rise over time. However, the economy builds new capacity every day through new companies and through investment and increased employment. We note that there is still some excess capacity in the labor market. There are people who are working part-time who would prefer full-time work. There's still below-trend participation in work by youth. and hours worked are lower than we would expect. Accordingly, what we expect to see, and what occurs at this stage of virtually every economic cycle, is capacity augmenting investment and the creation of new jobs at existing firms or at new firms, along with rising productivity. All this could mean higher potential output than we have built into our projection. Because this process is highly uncertain as to timing and size, we build it into our projection conservatively. But the bottom line is that the economy could be capable of generating more non-inflationary growth than we are assuming. Le troisième enjeu est la faiblesse continue de la croissance des salaires, alors que le taux de chômage se situe maintenant à peu près au même niveau qu'avant la crise financière mondiale. La croissance de l'emploi a certes été vigoureuse, mais les hausses des salaires n'ont pas affiché le même rythme. Cette faiblesse est due en partie aux ressources inutilisées sur le marché du travail dont je viens de parler. De plus, la relation entre la demande excédentaire et une hausse des salaires se fait également sentir avec un certain décalage. Cependant, il est aussi possible que d'autres facteurs, dont la mondialisation, influent sur la dynamique des salaires. The fourth issue that preoccupied Governing Council was elevated household debt and how that might affect the economy's response to higher interest rates. We've enhanced our main macroeconomic model used for projections to capture relevant details around housing and debt, and we have re-estimated all of our model's parameters using advanced methods. You can find details in the appendix in the MPR. We do find that the economy is likely to respond more to higher interest rates at today's debt levels than historically. Even so, we have to allow for the possibility that these improved estimates fall short of the mark. Furthermore, we have to watch how the household sector reacts to the new rules around mortgage underwriting. It will take time to understand the impact of these changes, as well as the economy's sensitivity to higher interest rates. Governing Council expects that incoming data and new research will shed more light on these four issues as we move forward. There's also a range of other risks that we outline in the MPR, which, taken together, give us a balanced outlook for inflation. As well, there is uncertainty surrounding the possibility of a significant shift toward more protectionist trade policies in the U.S., which we have chosen not to incorporate in our projection. Given our recent history with inflation running below target, we continue to be more preoccupied with the downside risks to inflation. The bottom line is that Governing Council will be cautious in considering future interest rate adjustments and will be guided by incoming data to assess the sensitivity of the economy to interest rates, the evolution of economic capacity, and the dynamics of both wage growth and inflation. And with that, Senior Deputy Governor Wilkins and I will be happy to take your questions.
So I have about 11, and I don't know if your 45 minutes starts now or your 2-minute statement, which turned into 10. But Andrea Tompkins from Reuters will take will ask the first question.
Thank you, Governor. You highlight the NAFTA risk, and there won't be an answer on that till March at best. January 17th is, at the heart of negotiating time. Does that mean that rate hikes are off the table till March, and can you afford to wait until it's resolved to pull the trigger?
So the NAFTA risk is outside of our projection for I think, evident reasons. We simply don't know enough about what may happen. The range of possibilities is too large for us to analyze. So, and even so, if something does happen in the NAFTA context, it could take quite some time after a decision is made before it's actually implemented. And so we need to take those things into account in due course when they come. At the moment, we're more preoccupied with the four issues that I outlined in more detail. These are issues which are fundamentally data dependent because we need to learn as we go how the economy is actually adapting to those things.
Andrew, follow?
Yeah. I'm wondering, is the bar higher for the next hikes than it was for the 2 insurance hikes, and particularly with some of those inflation variables that you mentioned? Do you focus less on inflation because the global forces can't be targeted?
We seek to understand all those inflation influences, whether they're domestic or global, because that's the only way we can decide whether they're fundamental, in which case they should be influencing policy, or if they're transitory and we should see through them. So, for instance, technological shock, which caused prices to be lower in certain categories for a period of time, would reduce inflation temporarily for, say, a year or perhaps a little bit longer. It would not be a permanent decline in inflation. And so we would seek to understand that so that we could, in effect, see through it and not react to it. And when we have positive disinflation of the type I just described, that's good for consumers, it's good for the economy, it's good, period. And it would be odd for monetary policy to try to boost inflation in other parts of the economy in order to offset that disinflation. So it's a process of understanding as opposed to pinpointing them as target variables. Would you like to add anything on this?
Well, I think the only thing to add is that when we dissected inflation, we can explain it by past output gaps and some of these transitory factors that the governor was talking about, food, exchange rate pass-through. And so that's what leads us to believe that inflation is going to go back to target. And where we're continuing the monitoring and the research is really leaving the door open to the possibility that there are some global forces, common global forces, particularly on the goods prices side, and effects from e-commerce that could be affecting Canada. If you look at our staff analytical notes that we've put out, you'll see that the evidence today isn't very compelling at all. But, you know, in the fullness of time with more data, and if you know anything about statistics, you know sometimes you need a bit of time to pass to actually see it. Some of that may show up, which is why we want to keep an open mind to what kind of processes might be affecting inflation.
David Aikens, Global News.
Just like to follow up on a couple of comments in your opening remarks. The first, you mentioned the Governing Council, I think, needs less monetary stimulus over time. In the last government, in the last year of the last government, you were adding stimulus by reducing. You had 2 rate cuts as the Harper government was withdrawing stimulus. Fiscal policy was withdrawing stimulus. Now we have a government, yesterday, is adding stimulus, an extra $2 billion in spending this year, out to about $4 billion in new stimulus in 2023. So I'm going to be a bit cheeky here. Why is the Bank of Canada for several years now working against fiscal policy makers who were trying to take stimulus out in the last government? Now they're trying to put stimulus in, and the bank has been doing the exact opposite. Could you explain to Canadians why the bank seems to be so offside with fiscal policy makers?
So we take the fiscal outlook into account in constructing our projection for the economy and inflation. So whatever fiscal policy is doing is a variable just like investment or consumption or exports that go into our model. And so for us, it's about not about whatever fiscal happens to be doing. It just happens to go into the mix of all those things. And then we forecast inflation, and if inflation looks like it's going to be too low, such as in 2015, then we reduce interest rates in order to buffer the economy from a shock. And we fast forward to this past summer where the economy had obviously worked off in macro sense the effects of that oil price shock. And so it, according to our projections, it was timely to bring those 2 interest rate cuts back out of the system. So yes, fiscal policy is modeled in our model. Of course it is. You refer to yesterday's fiscal update. You know, it's primarily a statement about how well the fiscal position is evolving. That's not a budget, so we wouldn't be incorporating any of those things. And regardless of whether they are stimulative or not, that's a net analysis which would have to take place once the budget is tabled and they actually become law. That's when they go into our forecast. So I won't speculate on that. Now that's a question for the finance minister.
And just the other comment you talked about, that this Governing Council was concluding that we might be more sensitive to an interest rate hike because of higher debt levels. I wonder if you could just talk a little bit more about that. In terms of sensitive, would it mean consumer spending would likely be tailed a bit, business investment, capital formation? How might it affect the savings rate? That would be different than other rising interest rate times. Can you talk a bit about that?
Carolyn, why don't you?
Sure. When households are more indebted, what happens is that any particular increase in interest rates is going to have a bit more of an impact on the amount of money they have at the end of the day to spend on other things. And so that consumption channel that you talked about is definitely present and more likely higher the debt level is. But at the same time, the ability of households to borrow more money, to get more credit, to buy new things is also going to be more constrained than it would have been in the past, at least for the households that are already quite indebted, because they're either going to need collateral or they're going to need the income to be able to support that. And there are limits to how much you can borrow. And those are just kind of two reasons why you might expect that the economy would be more responsive to interest rate changes than it was in the past. And in fact, the modeling changes that the governor talked about, we were always putting in, but we were able to add those in quite a detailed and satisfactory way in our forecasting model that's called Totem. And so we can actually model a lot of these channels through the evolution of household debt, the mix between who has a fixed rate mortgage, who has a variable rate mortgage, and how that feeds into borrowing constraints in a way that's going to help us monitor that as we go forward.
Greg Quinn.
Good morning. Some of the raw numbers in your economic forecast suggest that the economy's at full output, out of spare capacity. But your language used to describe that seems to be a little bit more reluctant to say that's the case. What's the misgiving here? Why aren't we following the numbers and saying the economy's now at full output?
Well, you used both terms in your question, so let me use both terms in the answer. So there is a distinction in our minds around full output, if you like, potential output, and full economic capacity. Usually, in most business cycles, they're pretty much parallel concepts. So you'll have an opening of the output gap, at the same time unemployment rate goes up, and then they tend to close again later, more or less together, more or less. But in a prolonged cycle, like the one we've been through, there's more of a divergence between them. And what that shows up as is an accumulation of excess capacity or potential in the labor market. Folks who have fallen out of the workforce, folks who are in part-time when they'd rather be full-time, they maybe have two part-time jobs, whatever. There's a sense in which the labor market is not at full capacity because there are people who are not fully employed as we expect. Whereas in the production side of the economy, all the things we look at suggest the economy is basically at full use of its resources. And in fact, in about 75% of the sectors in the manufacturing sector, they're above capacity levels. They're operating above capacity. So then, of course, what that means is that those companies are very ready to invest, even if uncertainty has been holding them back or slowing them down. If they're going to stay in business and continue to satisfy their customers' needs, they're going to invest. And as they invest, they often create new jobs in their organization, and that pulls those folks out of the excess layer, out of the labor market, and gives us more economic capacity when you combine the capital and labor together. And it usually shows up as productivity growth too, because you invest, even if you're not employing more, you invest and things are better. So for those two reasons, what we expect at this point in the cycle, I call it the sweet spot, is where you actually generate more growth than you were predicting and less inflation than you were predicting, because you're expanding the capacity of the economy, the supply side, and demand is barely keeping up with it. So it's literally the case that both of those things can be true at the same time. You're using all your output capacity, but there's still economic capacity in the system. And we're at that stage where that's why we want to monitor the labor market carefully to ensure that process is taking place. And we offer up a staff analytical note to explore, what a shock looks like if it's higher than we've assumed, et cetera. Would you like to add anything to that, or is that not a good answer?
I thought that's a
So
trick question. That's a trick question. That was a perfect answer.
Okay, thank you.
On another different topic, it looked to me like there are quite a few references to the Canadian dollar in this report. The assumption moves it up about 5 cents. But can you run through why it is that the high dollar figures so prominently in this report and how it filters through to your view on inflation and where the economy is going?
Well, as you know, we take the Canadian dollar as a factor that drives, it's a relative price that drives many things in our model, including inflation. So, but as well exports. And in this particular regard, the appreciation in the Canadian dollar does have a significant pass-through effect on inflation that peaks at around, takes off about 0.5 percentage points from inflation by the second quarter of next year, which is worth mentioning. It's something that that will mean that inflation will go sustainably back to 2 a little bit later than we thought, but it's also a temporary effect, transitory effect that we would look through. It also has an implication for exports that is determined in the model as well. And so, as usual, we just mention things that are pertinent for the model. When you think about changes in the dollar, I mean, clearly there's been, since the beginning of the year, broad-based U.S. dollar weakness against a number of currencies, and of course, the interest rate changes that we made.
Paul Vieira, Wall Street Journal.
Governor, when do you, what events or what developments would prompt you to not be so cautious or to maybe shift from this cautious tone that you've adopted in this statement?
Well, that was, I think, the whole point of my speech in St. John's was to underscore what data dependence would look like. I mean, of course, central banks always examine the data very carefully, but when you're in a situation which is different from normal, which we are, then you can't, you use your models as your guide, but you expect deviations in behavior relative to those models. And so the question is, how much of a deviation? So, for instance, the interest sensitivity of the economy, how much more sensitive will it prove to be? We don't really know, so we have to monitor how consumers and firms, actually, anybody with debt, how they are reacting to the interest rate hikes that are already in the system, right, to see how that is unfolding. So just as one illustration. So, you know, what's almost anything that represents a departure from our projections will be fodder for a discussion around whether the policy situation is the correct one. But we'll be interpreting those deviations through this lens of those 4 issues. Is that something that lies in, as I've just described, the potential growth rate space? Is that all that it is? If, let's say, the economy is stronger in Q3 or Q4 than we expect, well, we'll be interpreting it much more heavily than usual because we're trying to see evidence of those underlying forces that we've talked about. And if they're not there, then we'd say, well, it's just aggregate demand and the economy's hotter than we thought, so we need to think about our policy setting. So it's exactly why we must be open. You know, we could be surprised in either direction relative to our forecast. But we need to be extremely interpretive of those movements.
Do you have a follow-up?
Yeah. On the trade front, I know that you said you can't, you don't know what's going to happen on the NAFTA talks, but in the risks, in the section about the risks, you do discuss the potential of Canadian firms moving production offshore to avoid, as sort of to mitigate any risks of a shift in U.S. trade policy. Or are we seeing that now? Is that a real risk that capacity is going to grow elsewhere to mitigate against protectionism in the U.S.?
Yes, that observation reflects conversations with real companies that we have, that those are among the options that they have in front of them. We have, as is indicated in the report, we've embedded a degree of judgment in our investment outlook, which is to say companies are investing less than they would without the uncertainty around NAFTA. Even though investment intentions are solid in BOSS, even though investment numbers are much better than last year, it's all less than it would be without that uncertainty. And so that's something that we have to continue to watch, because NAFTA itself, you know, when people talk about, well, if suddenly we have tariffs where there used to be none, you know, those kinds of tariffs, like in a WTO type of tariff regime, you know, those kinds of tariffs are smaller than the exchange rate adjustment that we've had this year. So it's how companies adapt to a new world is complex, and it depends on the company. But you should bear in mind that, you know, a company can adapt to those kinds of shocks. But one of the possibilities on their horizon is to, since they're all ready to expand, well, let's expand the operation in the U.S. instead of in Canada, because that hedges the risk that something will happen in NAFTA. So all those possibilities are there, and they're in our conversations, but we can't possibly put that into some sort of projection or anything. But in the end, it'll be what happens, and we'll see how the economy reacts to it.
Kevin Carmichael, Maclean's.
Governor, this question relates a little bit to your response to Paul's question. I'm going to ask it anyway in case it elicits a little more information. There's a constituency of market participants that think the central bank should be raising rates or should be on a defined path to higher interest rates. Their analysis tends to be based on historic relationships, Taylor rules, that sort of thing. Is that sort of analysis at all useful at this juncture, given what you've told us today?
Well, I think that that framework indeed is exactly how we operate our own projection model with a policy rule like of the Taylor type, the Taylor family. You need that in order for the model to solve. You know, it has to have that kind of information for the model to solve. So that gives you a starting point. And then what happens next is you talk about all the reasons why, you know, it's not as simple as that at this point in time. It may be that simple at times, or even on average, but there's long times like now where it simply isn't the right answer. But it is a very useful framing discussion to say, well, what would, you know, our basic rule tell us we should be doing, and so how much of a gap are we, or how far away from that are we, and how would we work that backwards to reconcile it with our judgments on these other issues that I've laid out. So it's a very useful exercise in that sense.
Second question, not unrelated, but to what extent is the U.S. experience over the last couple of years relevant to what's going on in Canada now? I hear lots of echoes of what the Fed went through over the past few years, and certainly what you've been telling us over the last few months.
Yeah, I think quite relevant. You know, if you think about the long sweep, the oil shock that we went through end of 2014 into 2015 had us cutting rates in the same year that the Fed raised rates, which does a couple of things. It just demonstrates how divergence can occur, and how an independent monetary policy needs to be directed at your objectives, not someone else's. But it also gave us, in effect, about a 2-year delay in the process of getting back home. And so in that sense, the U.S. now is out in front of us, whereas we were more similarly situated, I would say, before the oil shock came along. And so that just tells you that that process of expanding the supply side of the economy, drawing more people out of the excess capacity that's in the labor market, and converting that into more capacity overall for the economy, and continually sort of trying to catch up to your inflation target. And as I said, that's a very positive thing in that sense, right? It means that the economy is expanding inflation-free, farther than what many people thought when it began. And so that's what I mean in the sense of free. It's like if you nipped it in the bud, wouldn't you regret it afterwards? So.
David Cochran, CBC.
In the past, you've credited the Canada Child Benefit for having a highly stimulative impact on the economy. Yesterday, the checks were indexed to the cost of living starting next year. Do you think that will have a similar economic impact? And given what you're saying about the reduced need for monetary stimulus in the economy, is it necessary that the government do this at this time?
Well, I don't think I should comment on the specifics of what the government has tabled, but I can go back and say yes, the Canadian Child Benefit, which hit mailboxes just over a year ago, I guess July, I think it was last year. We calculate added up to 0.5 percentage points onto the level of GDP. So if we go back to where we were working with a 1 or 1.5 or 2% output gap, using up 0.5 point, half a percentage point of that with that one policy alone was a significant contributor to us getting back home. The alternative, during the oil price shock would have had to been even lower interest rates in order to have the same effect or have the same, be that as close as we are now to our inflation target. So as for the change, it doesn't sound, at the moment, it doesn't sound anywhere near as large as what was done last year. It's just making it in real terms, it's maintaining it. So, but I'm not going to speculate on what it means in terms of stimulus or non-stimulus.
The other big stimulus move from the government has been their infrastructure plan. You have a note on the bottom of page 16 where you talk about persistently weaker than expected data for government infrastructure spending, suggesting more modest pickup in the current year and therefore a smaller payback thereafter than was projected in July. Does that mean it's just not working, or the money is not getting out the door and going into projects as expected?
Yeah. It means that the process of the money hitting the street has been slower. Carolyn, would you like to elaborate?
I think the only thing to elaborate is that we haven't changed our view on the amount that's eventually going to get out the door. It's really a question of timing, and that's a function of how they set the program up to create clear objectives and guidelines, and that process takes time and planning.
Rahul Vidayana, the Epoch Times.
Good morning. Just going back to the globalization and digitalization not having much of an effect on Canadian inflation, can we also take that to mean that in your analysis it doesn't have much of an effect on raising potential output? So, and also why, I guess you think it may be a more temporary phenomenon than systemic? Well,
that's a complicated question. So, so the answer probably to all of that is yes. But I'm kidding, of course. But because it has all those potential effects. So what we've tried to do is to see, to the extent that we can, to what extent is digitalization, having these effects. You're in a store and you're looking at I don't know, an item, whatever it is, DVDs at Costco or something, and you're like, well, I wonder how much that costs on Amazon. It's just instantly you can compare your prices, and that we think has a competitiveness effect, and no doubt, absolutely no doubt, is having an effect on inflation, or at least on prices. Perhaps not a persistent effect on inflation. We know it anecdotally, but can you prove it in your models and so on, which is a steeper challenge. But potential output, that's a whole other matter. That's exactly why indirectly expanding the supply side of the economy can lead to inflation to be lower than otherwise, and it could be having that through that channel instead of the direct channel that I just described a second ago.
So on the digitalization, it's really interesting because many people expect it to be the hope for increased productivity and kind of a recovery in productivity, if you will, that we're all looking for. If you look at the data on the effects of digitalization on productivity, you really don't see a lot there, and it could be because it's just early days for diffusion of that kind of technology. And so we'll see it eventually. In our own base case projection, what we've assumed is a normal cyclical recovery in productivity back to trend, but we haven't built in an increased productivity in a structural sense coming from digitalization, and that's just because it's the kind of thing you want to be prudent about. It's a structural change. You want to see a bit more evidence. It's not just something people talk about, but something that you see in the data. And so that's the reason why we're doing such an incredible amount of monitoring, but not yet ready to put that in our base case.
And so you would say Canada's maybe a little bit behind the curve as compared to other countries because it's had a greater impact on other countries?
Well, I think the evidence in terms of productivity and digitalization is not strong in any country. That's for sure. With respect to e-commerce, which is a bit of a different question, and how that's affected the price-setting mechanism and the degree of contestability in markets, you do see some stronger yet still kind of weak evidence in other countries, Europe, Sweden, for example, who actually make more use of e-commerce than Canadians do.
Peter Diekmeyer, Live Squawk. Do you have a question?
Yes, I do. I noticed that according to the World Gold Council reports that Canada once again ranks last in the G7 in terms of its gold holdings. Now, given all the uncertainties in the economy, and particularly the unconventional monetary policies that are adopted by the world's central banks, shouldn't the Bank of Canada be hedging its bets? And I'm wondering what your team's thinking is on that matter.
Well, I guess to start, Canada's foreign exchange reserves are the responsibility of the Minister of Finance. They are, of course, administered by the central bank, but it's not the Bank of Canada's decision about how big it is or what form it takes. So any questions about gold, its role to be played there, it's really should be directed somewhere else. But we do have a lot of reserves, so if the point is, if the basis of your question is, are we prepared for volatility in markets, the rough guide is it's around 3% of GDP that we have in stock, and it's distributed amongst a number of currencies. It's fully hedged so that it doesn't have any exposures to exchange rate moves or interest rate risk, that sort of thing. So it's like $75 billion. I guess that's the latest number I have in my mind.
Yeah,
Is that on a trade-weighted basis?
Sorry?
Do you govern that on a trade-weighted basis? Your foreign reserves, based on how much trade we do with foreign countries? Like with the U.S. dollar has a hard position, and we roughly corresponding to the 75% of GDP.
Yeah, again, the composition is a judgment reached by the finance department. We administer it for them. We're part of the group that examines those issues, but it's really not our decision. So I'd like to.
Greg Bunnell, BNN, is he still here? Did he leave? No, he left. Okay.
Well, let's consider his question answered.
Andy, you were on my list.
Sure, yeah. Yeah, I was wondering a bigger picture question. We've been hearing a lot about how Canada's doing relative to other advanced economies, and I'm just wondering, on a lot of areas actually, we hear a lot about it, and I'm just wondering the areas where you think Canada is lagging,
Yeah, I think that's probably why I go back to the discussion of what we economists call the endogenous creation of more capacity, which we talked about. That's the combination of new investment, new firm creation, and the creation of new jobs basically out of thin air, which is what we're talking about. That process, one of the key indicators of that process would be net firm creation, the population of companies, and that's one of my favorite variables, and it is really not shown what we're looking for yet. So it's proving to be a very slow process, and that's that's one, and if compared to the United States or compared to the UK, we're definitely not producing new companies in the way they are. And so it may just be because we're still working off the legacy of the oil price shock, and so that's our basic hypothesis, that we're hitting the sweet spot, not in it, but hitting it. And so I have every reason to have every faith that it's going to occur, but that's exactly why we don't assume it. We have to see it happening before we can believe it.
Do you have a follow-up, Andy? Sorry, it was Andy Blatchford, CP. Jesse Snyder, National Post. You were on my list coming in, but no. Because if not, I can move on to Karina.
Elaborate on where you expect the business investment to come from, what sectors specifically, and is the natural resources sector. Can you just give me a sense of where that falls?
Okay, so it's in the first half of this year, it's become actually quite widespread. You have to you're really only your source of this is the national accounts, where you get the kind of detail that you need to see where the sectoral breakdown is. But you know, up until the first of this year, of course, we know that the energy sector was basically out of action, but they came back in, and at a time when everybody else was gathering momentum. So there's almost no excluded sectors. And like I said before, 75% of manufacturing firms are excess demand relative to their capability. And that gives you a sense of just how many sectors are primed and ready. And, you know, sometimes exchange rate fluctuations can speed it up for some companies, slow it down for others. It's a complicated story. The other thing that just has come in is that non-residential construction has now picked up. Well, this is our first really clear sign that it's very likely that the infrastructure program is starting to hit the big numbers, as opposed to just getting money out the door and hoping that it starts to show up. So that, of course, is an important driver of, you know, infrastructure investment is really important to almost all companies. So that's the kind of combination we're looking for. I think it's there. It won't go in a straight line, so we have to be ready for it to falter and then pick up again and so on. It's a highly variable process, lumpy, basically. Is that good? Okay.
Sorry, Karina Roman, CBC.
Hi, just following to David Cochran's question from earlier. While you don't feel like commenting specifically on whether or not the child benefit indexation will be a stimulus or not, and it's certainly clear that the government hopes that it and the other measure they introduced yesterday will, if not be a stimulus, at least maintain the stimulus. And while the economy is growing the way it is right now, I guess the question is, do you think that is the right approach to be, regardless of whether it does stimulate or not, trying to obviously maintain or increase the stimulus at this point?
Yeah, so I'm not going to express a judgment about what the government's objectives are and whether they're appropriate. But what we try to do is to incorporate the things that they have done as carefully as we can, so that we understand how they will affect the outlook. And so, as I mentioned, that the child benefit did bump up GDP growth for a year by 0.5%. That's 0.5 on the level of GDP. And that level effect stays in there because we're not taking it away. It stays in there, but the growth effect goes away around now. Okay, so it only bumps up growth for 1 year after it's in, and after that it's just part of the level story. If you index it, that just makes sure that in real terms, or after adjusting for inflation, that level is kind of maintained. So it's not about whether or not something is stimulative on top of this, okay, which is the question you seem to be getting at. And we're not in a position to analyze that because you don't have the budget, which is where they work out all the numbers, take these things and put actual numbers beside them, and then we can plug it into our models. But that'll be a job for next April, you know, when after an actual budget occurs.
Do you have a follow-up, Karina?
Excuse me, if you have answered this before, I was a little bit late. In terms of you're talking about being cautious going forward with interest rates, just also looking at what the government was saying yesterday, can you talk a little bit about what the underlying concerns are? Just feeling like, okay, we've got this hot economy right now, but Is there this fear that it's not really solid, that it's not locked in, the trajectory we're on?
No, it isn't that at all. The economy has been extraordinarily strong in the first half of this year, and we said in July that it would for sure moderate as we got into the second half of the year, and it is indeed happening. That moderation is welcome because 4.5% growth is not sustainable in any economy like ours. We're going to settle down to something more like, like it says in our report, 2.1% for next year versus 3.1% for this year. That still is above the economy's potential, but our caution comes from not knowing for sure how the economy will react to the interest rate hikes that we've already made, the mortgage rule changes that have been put in place, how it's reacting to that extra growth in terms of supply creation, and how the inflation process is behaving given these global forces that appear to be acting on inflation technology, as Carolyn was talking a few minutes ago, in lots of countries. And in the labor market, why are wages still sort of slow is that we need to understand that really well. We think we understand it today, but we have to monitor it to make sure that understanding holds up. So that's the data-dependent notion that we have there, and that's why there's caution. There's nothing automatic, no predetermined path for interest rates, only a clear assessment that, yes, over time, if the economy continues to behave as it has, less monetary stimulus will be needed because the economy will be getting very close to home. But in the meantime, we have to watch these things to see when is the appropriate time.
That's our time. We have just a couple of other follow-ups. Can you get
two
quick ones?
Two quick ones,
Andrea
absolutely.
Tompkins from Reuters had a follow-up. Well, just one question, no follow-up, and then Dave, and then we're done.
Understand. Following on that, expectations for the next hike have been pushed back based on what you've said today. Is a rate hike still on the table in December?
Well, I think every meeting should be seen as a live meeting. We are data dependent, and there will be data that we get between now and then. So I think it's best that we leave it exactly like that. If the data are telling us our forecast is wrong, that's when we would reconsider our policy setting.
David Aiken, Global.
So just to put a fine point on what the three of us have been asking on fiscal policy versus monetary policy. I'm a homeowner, and I might be in a situation where rising interest rates are going to hurt me. And I may look at the statement yesterday and go, geez, the finance ministry has put more stimulus into the economy, and the bank's going to respond by raising interest rates faster and higher because of that stimulus. And what I'm hearing from you is, don't worry about it for at least 6 months, 8 months, till after the budget. You don't even have to think about that. The bank is not alarmed about anything it read about the fiscal update at this point in time. Feel free to wave me off any of my conclusions here.
Well, you've turned that into a very complicated question.
Okay.
So what I said was, I'm not in a position to judge whether or not the budget indications we got yesterday, the update, are stimulative or not. So I'm not going to draw any conclusions about whether it's stimulative. It would have to be considered in the context of a complete budget, which we will not have until the snow's melting, right? So let's set that aside. So let's talk about your homeowner. The homeowner should acknowledge that, as we say in the press release, that if the economy continues to do well, as it has been, less monetary stimulus is likely to be needed in the future. But we're not, because of that, we said, well, that's the framework we begin with. What is it we need to know in order to understand how the economy is actually behaving? And we've laid out the 4 issues. Those are the things that we're focused on, because if we just take, for one example, let's suppose the supply side of the economy is evolving, as I said. Well, it means that if it produces more supply than we're forecasting, given the demand that there is there, we will undershoot our inflation target a year and a half from now. Well, so as that evidence became clearer, we'd say, yeah, we were right. It's happening. So that would mean that interest rates can stay low longer because there's more growth isn't inflationary. But if it's some other interpretation, then it wouldn't be the case. And so we have to interpret all those data as we come along and revalidate our story in real time. I'm afraid I can't tell you, well, it'll be 6 months, 9 months, or 3 months, or December.
He won't tell you whether
It's-
you can
it's
lock in
real
your
time.
mortgage.
It's
He wants
real.
to know, can he lock in his mortgage?
We learn from every data point, you know, so, and of course, when there's more than one in a row, then you start learning more, right? So I'm sorry if that sounds complicated, but in fact it is.
Okay, thank you very much, sir. Appreciate
Thank you very
it.
much.